Why sneaky quantitative easing QE is back. Do this now. Stock to be fueled by Fed liquidity until this. I have some good news and some bad news. Let's start with the bad news. Q1 GDP growth was just revised to 2%. The previous estimate was 1.3%. Cheers to another quarter of avoiding the start of a recession. However, that is why TLT got sold off again. Now it's time for the good news. Global supply chain pressure has dropped to the lowest since 2008. Meaning, if this inflation problem that we are having was mainly due to supply chain issue, well, that's no longer an issue, according to New York Fed, which is in line with the Trueflation CPI reading of 2.48% right now, which explains why there are 42% of investors are bullish today and the market is feeling extreme greed. Does this remind you of 2019? Why sneaky QE by the Fed is back. I will explain it all right after this.
How you like that? How you like that? Nah. Look at you, now look at me. Look at you.
Welcome back to the Audacious Money Witch channel, where we talk about macroeconomy, stocks, bonds, and commodity markets. If you like any of these topics, you are intelligent. That's why you're here, and you know what to do, and push my button if you like what you see in today's video. Because you're already a success, it is done when you join the Audacious Money Witch Club. This video is brought to you by my website. If you are a good boy, go to audaciousmoneywitch.square.site to add more meaning into your life. If you play your cards right and completely submit like my good boys do, then I will take you under my wing. Author of best-selling books, Goddess Cheryl. My good boys always get rewarded handsomely. You are such a good boy. You like hearing that, don't you? You want to get into the bookstore. You want it to be real. You want it to be true. You want to join the Audacious Money Witch Club, don't you? Rising world stock markets appear to confirm that global liquidity, the pool of cash and credit shifting around financial markets, is once again expanding after skidding lower last year. So much then for central bank quantitative tightening, the much mooted unwinding of the massive stimulus programs to support markets and economies. Our estimates show that the liquidity cycle bottomed during October 2022 in the wake of former UK Prime Minister Liz Truss's mini-budget debacle, and looks set to trend higher over the next few years. Investors should therefore expect a continuing tailwind from global liquidity instead of last year's severe headwinds. This should prove good for stocks, but less positive for the bond investors. Britain's gilt sell-off last autumn gives us a foretaste of future challenges for sovereign debt markets and points to some coming hard decisions for both policymakers and investors. The integrity of banks and sovereign bond markets are sacrosanct in modern finance. Led by the U.S. Federal Reserve, central banks have just injected substantial cash into money markets over recent months, helping to bail out flaky banks. But in coming years, they will probably have to bail out debt-burdened governments too. In short, markets need ever more central bank liquidity for financial stability, and governments will need it even more for fiscal stability. In a world of excessive debt, large central bank balance sheets are a necessity. So forget QT, quantitative easing is coming back. The pool of global liquidity, which we estimate to be about $170 billion, is not going to shrink significantly anytime soon. The promised fall in the size of the U.S. Fed's balance sheet has been far from convincing. Falls in direct bond buying have been offset by other Fed liquidity, creating programs such as short-term lending to commercial banks. A rundown of the Treasury General Account, the government's check account at the Fed, and small withdrawals of deposits at the central bank have also contributed. On top of this, the U.S. Treasury is debating buybacks to improve bond market liquidity, targeting sales of bills to money market funds, and is likely to reduce the average duration of treasuries available for private investors to boost demand. All will help to boost global liquidity. Expect more of these unconventional policy twists in the future. The past 2 roller coaster decades have shown how financial markets need liquidity to roll over the vast debts built up by corporations, households, and governments. We estimate that a whopping 7 in every $8 changing hands in the world financial markets are now used to refinance existing debts. An increasing share of the $1 left over for new financing is applied to fund swelling government deficits. Looking ahead, the advanced economies face renewed pressures on public finances as military requirements and demographics boost mandatory spending, while the tax base is compromised by larger numbers of retiring high-wage workers. On top, international tax competition probably rules out substantially higher marginal rates. Consider U.S. fiscal math. The U.S. government will need to sell an average of $2 trillion of treasuries each year over the next decade. And according to the latest Congressional Budget Office forecast, the Fed will be required to chip in. The CBO estimates that Fed holdings of U.S. Treasuries will have to rise to $7.5 trillion by 2033 from current levels of nearly $5 trillion. No QT here, but worse, these CBO spending projections are likely too low, especially for defense outlays. More realistic numbers point to required Fed Treasury holdings of at least $10 trillion. That translates pro rata into a doubling of its current $8.5 trillion balance sheet size and will mean several years of double-digit growth in Fed liquidity. Looking around, there are not many alternatives to this Fed QE. Mandatory spending is effectively already set in stone, and tax bases have been squeezed dry. Foreigners hold about 1/3 of U.S. debt, with China still a major investor, but growing geopolitical tensions will probably reduce their appetite. How about domestic U.S. households and pension funds? The trouble here is that higher interest rates may be required to entice them into bonds, especially when the threat of monetary inflation looms large. Yet higher interest rates boost the fiscal deficit, requiring still greater amounts of debt, thereby compounding the problem. As they joke in Ireland, if you want to travel to Dublin, don't start from here. Here is why I turned bullish recently. I expect stocks to go up until Fed cuts rates. I am about to drop some big psychological gems. Stay tuned for a free gift at the end. It's obviously easier to talk about than to implement these investing wisdom visualization, but it's important to understand the key point here. We are all our worst enemies. Psychology ultimately taxes our returns more than anything else. Learning to stop blaming others, focus on what you can control, and staying disciplined in the face of volatility clearly pays off long term. Definitely something to inspire to. We are living through the most disruptive period in human history. AI, blockchain, cloud computing, digital wallets, just to name a few. In the long run, stocks wins, bonds second, cash got inflated away. High inflation times demolishing bonds return. You make far more money by holding through bull markets that you lose by holding through bear markets. Average bull market lasts 6 years with cumulative return of 300%. Average bear market lasts 1 year with loss of 38%. Investors are their own worst enemies. Why do they underperform? Their behavior? This chart shows average investor can only get 3.6% versus S&P 500, 9.5% from the last 20 years. Noted 60 over 40 can get 7.4% return. The market cycle wreaks havoc on investors' emotions. Most investors recognize the cycle of market in theory, but when you are in the roller coaster ride, only the best investors can control their emotions very well. We are trying to get there. New technologies put investors through even more extreme emotional cycle. The Gartner hype cycle is real. Study it. This is what just happened to AI. The cost of earning superior long-term returns is dealing with large drawdowns. They are normal. Expect them. The intra-year drawdowns can be just as crazy, even during up years. There will always be a smart-sounding reason to sell. Politics and investing don't mix. However, politics affect trading outcome, especially energy policy. Ignore forecasts. Professional forecasters can't even predict the direction of interest rates, let alone the magnitude. In the short term, changes in valuation drive returns. In the long term, changes in sales and profits drive returns. The easiest way to increase your odds of success is to increase your holding period. Stocks occasionally give you nothing. Plan accordingly. Start investing early. If you're still here, as a thank you, I have a free ebook for you. Feel free to grab that free gift at the pinned comment below. And I thank you for watching my video today. Here is my client Teddy Eazzy's book, Wicked Pussy Perfume. It is a femdom novel and it's about high heels, stockings, and stocks. You are such a good boy for watching my video right till the end. Bye.